The 2026 financial crisis isn't coming, it's already here. A comprehensive 3,000-word guide to understanding what's happening to your money and the only system that will protect it. Introduction, a warning from the front lines of finance. Let's start with a brutal, undeniable fact. The purchasing power of your life savings is being systematically erased right now as you read this sentence. You haven't made a glaring investment mistake. You haven't gambled it away. You've likely done exactly what you were told was responsible. You've saved diligently, lived within your means, and trusted in the stability of the system. And that, in the current economic climate, is precisely what makes you most vulnerable. The average American has approximately $65,000 in savings. In the United Kingdom, the average household has about £17,000 set aside. This money, the product of sacrifice and discipline, sits predominantly in traditional bank accounts, earning what appears on the surface to be a reasonable 4 to 5% interest. It feels safe. It feels prudent. It is a catastrophic financial error. Over the past 4 years, cumulative inflation in both the US and UK has exceeded 20%. A simple, devastating equation. If you held $100,000 in cash in 2020, its real purchasing power today is roughly $80,000. You lost $20,000 not through action, but through inaction. The very bedrock of conventional financial wisdom, save your money in the bank, has become a slow-motion wealth destruction vehicle. This paper will dismantle the comforting illusions of modern personal finance, expose the unique and converging threats of the 2026 economic landscape that most advisors are unequipped or unwilling to discuss, and provide you with a complete, actionable, and historically proven system for not just preserving but growing your wealth through the turmoil ahead. This is not about fear-mongering. This is about clarity, understanding, and empowerment. The solution I will outline is not complex, exciting, or trendy. It is profoundly simple, almost boring in its execution. It has worked for nearly a century. It protected wealth through the Great Depression, the stagflation of the 1970s, the dot-com bust, and the 2008 global financial crisis. It is the quiet strategy of the truly resilient, and it begins with understanding the battlefield. Chapter 1. The Illusion of Safety. How Safe Savings Became the Riskiest Asset. For generations, the savings account represented the pinnacle of financial virtue. It was secure, government-insured, and provided a modest return. This paradigm is not just outdated, it is dangerously inverted. To understand why, we must examine the two fundamental forces conspiring against your cash: inflationary erosion and the coming rate cut trap. The silent thief, inflationary erosion. Inflation is often discussed as a percentage point in nightly news headlines. CPI up 0.2% this month. This abstraction numbs us to its visceral, real-world impact. Inflation is not a statistic, it is a stealth tax on every unit of currency you hold. The 20% plus cumulative inflation since 2020 means that the basket of groceries, tank of gas, or year of tuition that cost $100 in 2020 now costs $120. Your cash, however, has not kept pace. The critical flaw in public understanding is the focus on nominal versus real returns. A 4.5% savings account interest rate sounds positive, but when inflation runs at 5%, your real return is negative 0.5%. You are paying the bank to hold your money. This negative real yield is a permanent compounding leak in your financial hull. Over a decade, even modest negative real returns can eviscerate half of your purchasing power, turning a comfortable retirement nest egg into a pittance. The 2026 rate cut trap, the looming double blow. The current higher interest rate environment is an anomaly, a desperate corrective measure by central banks to combat the inflation surge. This is setting the stage for the next phase of the crisis. Economies are now slowing under the weight of these higher rates. Growth is stalling, unemployment pressures are building, and political demands for relief are rising. Central banks will inevitably cut rates. It is not a matter of if, but when. When they do, the interest rate on your high-yield savings account will plummet, potentially to 2% or lower. However, inflation is a sticky phenomenon. It rarely descends as quickly as it rose. The likely scenario for 2026 is what economists call a policy mistake or a stagflation-light environment. Low interest income for savers coupled with persistently elevated inflation. Imagine earning 2% on your cash while prices rise at 4%. Your real loss accelerates to negative 2% annually. The erosion of your wealth doesn't just continue, it accelerates. This is the trap. The temporary relief of higher yields is a lure, distracting from the permanent structural vulnerability of pure cash holdings. Chapter 1. The Illusion of Safety. How safe savings became the riskiest asset. For generations, the savings account represented the pinnacle of financial virtue. It was secure, government-insured, and provided a modest return. This paradigm is not just outdated, it is dangerously inverted. To understand why, we must examine the two fundamental forces conspiring against your cash: inflationary erosion and the coming rate cut trap. The silent thief, inflationary erosion. Inflation is often discussed as a percentage point in nightly news headlines. CPI up 0.2% this month. This abstraction numbs us to its visceral, real-world impact. Inflation is not a statistic. It is a stealth tax on every unit of currency you hold. The 20% plus cumulative inflation since 2020 means that the basket of groceries, tank of gas, or year of tuition that cost $100 in 2020 now costs $120. Your cash, however, has not kept pace. The critical flaw in public understanding is the focus on nominal versus real returns. A 4.5% savings account interest rate sounds positive, but when inflation runs at 5%, your real return is negative 0.5%. You are paying the bank to hold your money. This negative real yield is a permanent compounding leak in your financial hull. Over a decade, even modest negative real returns can eviscerate half of your purchasing power, turning a comfortable retirement nest egg into a pittance. The 2026 rate cut trap, the looming double blow. The current higher interest rate environment is an anomaly, a desperate corrective measure by central banks to combat the inflation surge. This is setting the stage for the next phase of the crisis. Economies are now slowing under the weight of these higher rates. Growth is stalling, unemployment pressures are building, and political demands for relief are rising. Central banks will inevitably cut rates. It is not a matter of if, but when. When they do, the interest rate on your high-yield savings account will plummet, potentially to 2% or lower. However, inflation is a sticky phenomenon. It rarely descends as quickly as it rose. The likely scenario for 2026 is what economists call a policy mistake or a stagflation-light environment. Low interest income for savers coupled with persistently elevated inflation. Imagine earning 2% on your cash while prices rise at 4%. Your real loss accelerates to negative 2% annually. The erosion of your wealth doesn't just continue, it accelerates. This is the trap. The temporary relief of higher yields is a lure, distracting from the permanent structural vulnerability of pure cash holdings. Chapter 2. The Elephant in the Room. Currency devaluation as policy. Beyond the business cycle of inflation and interest rates lies a deeper, more insidious threat: The deliberate devaluation of currency as a tool of government policy. This is not a fringe conspiracy theory. It is the cold, mathematical reality of modern sovereign debt management. A century of erosion, the historical record. Since the creation of the Federal Reserve in 1913, the U.S. dollar has lost over 96% of its purchasing power. The British pound tells a similar story. 1 pound in 1913 is worth less than 5 pence today in real terms. This is not an accident or an inevitable law of nature. It is the consequence of a system based on fiat currency, money not backed by a physical commodity like gold, but by government decree. Governments, when faced with unsustainable debt burdens, historically have 4 options: raise taxes, politically difficult; cut spending, politically difficult; default, catastrophic for credibility; inflate the debt away, politically invisible. Option 4 is the path of least resistance. By allowing or actively engineering currency devaluation, a government reduces the real value of its debt. A $34 trillion U.S. national debt is far less burdensome if future dollars are worth significantly less. The cost of this soft default is borne not by the government, but every holder of that currency, you. 2026 global currency war escalates. The debt picture today is unprecedented. Global debt to GDP ratios are at all-time highs. In this environment, competitive devaluation, often called currency wars, becomes a tempting tool. Countries may seek to weaken their own currencies to boost exports, making their goods cheaper on the world market. When multiple major economies engage in this race to the bottom, it creates a vicious cycle of devaluation. Your savings, denominated in dollars, pounds, or euros, are direct claims on these depreciating assets. In a global currency war, cash is not a safe harbor, it is the battlefield itself. The financial system of 2026 will be shaped by this geopolitical fragmentation, where trade alliances shift and economic blocs compete. In such a world, the faith-based value of fiat currency will be tested as never before. Chapter 3: The Behavioral Pitfall: Why Panic is the Greatest Threat to Your Wealth. Understanding these macroeconomic threats is crucial. But the single greatest destroyer of individual wealth is not inflation, rate cuts, or devaluation. It is emotional decision-making. The human brain, brilliant in so many domains, is disastrously wired for financial markets, which are cold, probabilistic, and counterintuitive. The cycle of fear and greed. The financial media and advisory complex thrives on this vulnerability. Their business model depends on keeping you in a state of heightened emotion, fear that prompts you to sell, greed that prompts you to chase, and confusion that makes you dependent on their next piece of guidance. This generates clicks, views, and, most lucratively, transaction commissions. This cycle manifests predictably. The slow erosion phase. Savers gradually lose purchasing power to inflation, feeling a vague unease but taking no action. The crisis catalyst, a market correction, geopolitical event, or sharp inflation spike triggers fear headlines. The panic sell-off. Individuals, seeing nominal account values drop, sell their productive assets, stocks and bonds, at depressed prices to move to safety, cash. The missed recovery. Markets inevitably stabilize and begin their long-term upward climb. The panicked investor, now in cash, misses the entire recovery, locking in permanent losses. The chasing phase. Eventually, FOMO, fear of missing out, sets in. Seeing others profit, the investor buys back in, often at higher prices, just before the next downturn. This buy high, sell low pattern is the antithesis of wealth building. More fortunes have been lost by attempting to time the market and avoid short-term pain than in any single market crash. The 2026 amplification effect.
In the fragmented, headline-driven, and volatile environment predicted for 2026, this emotional amplification will be supercharged. AI-driven news algorithms will optimize for fear. Social media will be awash with extreme predictions. The noise will be deafening. Your greatest defense will not be a better prediction of the future, but an unwavering commitment to a system that operates despite the noise. Chapter 4. The Pillars of Permanence, a 4-part system for all seasons. We now turn to the solution, not a single stock tip or asset allocation magic bullet, but an integrated, holistic system. This framework has 4 interdependent pillars. Neglect one and the structure weakens. Implement all 4 in harmony, and you build a fortress of financial resilience that can withstand virtually any economic weather. Pillar 1. The Power Gap. Spend significantly less than you earn. This is the foundational pillar, so simple it is often dismissed, yet so critical it determines everything else. Wealth is not a function of income, it is a function of the gap between income and spending. The typical treadmill. The average household saves 3 to 4% of its income. At this rate, building meaningful capital is a generational task, and any emergency wipes out progress. They have no margin for error. The engine of resilience. Wealthy households, regardless of income level, engineer lifestyles that maintain savings rates of 20%, 30%, or even 50%. This gap is not leftover money, it is strategic capital. It is the fuel for investment, the buffer for emergencies, and the source of true optionality. Action for 2026. Conduct a ruthless audit of your cash flow. Not with guilt, but with the analytical eye of an engineer. Identify every outflow that does not contribute directly to your health, security, or genuine happiness. This financial pruning frees up capital to be deployed into
the next 3 pillars. In an uncertain 2026, this gap is your lifeline. It allows you to endure job instability, absorb unexpected costs, and invest when opportunities arise. Pillar 2. Own productive real assets, your hedge against devaluation. Cash is a claim on a deteriorating promise. A productive real asset is a claim on something tangible that generates value. When you own a share of a company, you own a sliver of its factories, patents, workforce, and customer relationships. These entities adapt to inflation by raising prices. Their nominal revenues, profits, and ultimately their stock prices are recalibrated in line with the depreciating currency. The philosophical shift. Move from thinking, I have $10,000 in savings, to I own a fractional share of hundreds of global businesses. Your wealth is no longer a number in a bank's database, but a portfolio of cash-flowing enterprises. The practical path. Low-cost, broad-market index funds. You do not need to be a stock picker. The simplest, most effective method is to own the entire market through funds that track indices like the S&P 500 or a global total stock market index. This provides instant diversification and captures the aggregate growth of global capitalism. Over the long term, the upward trajectory of corporate earnings has consistently outpaced inflation and currency devaluation. Pillar 3. Maintain strategic liquidity, the safety net and springboard. This pillar seems to contradict the previous one. If cash is eroding, why hold it? The answer: optionality. A dedicated pool of highly liquid capital, 6 to 12 months of essential living expenses, serves 2 vital functions. An unshakable safety net. It prevents life's inevitable emergencies, job loss, medical issues, major repairs, from forcing you to sell your long-term productive assets, Pillar 2, at a potentially terrible time. This is the buffer that lets you stay in the game. And a source of opportunistic power. Market panics create generational buying opportunities.
When fearful investors are selling valuable assets at fire sale prices, you need dry powder to act. Your liquidity pool transforms crisis into advantage. Think of this not as an investment, but as insurance. Yes, you pay a premium, the loss to inflation. In return, you buy peace of mind and the potential for monumental opportunity. Pillar 4. Automate everything. Become a manager, not a reactor. This is the behavioral keystone. It recognizes that you, as a human, are the weakest link in your financial plan. The system must be designed to operate without your constant emotion-prone intervention. Automate savings and investment. Set up automatic recurring transfers from your checking account to your investment and liquidity accounts immediately after each paycheck arrives. The money is gone before you can contemplate spending it. Automate purchases. Within your investment account, automate the regular purchase of your chosen index funds. This practice, known as dollar cost averaging, ensures you buy more shares when prices are low and fewer when they are high, smoothing out market volatility. The result? You become the architect and steward of a self-executing machine. You review it quarterly or annually, not daily. You are insulated from the emotional whirlwind of market news. The wealthy don't have superior willpower. They have superior systems that make willpower irrelevant. Chapter 5. The 2026 Action Plan. Step-by-step implementation. This is where theory meets practice. Follow these steps in order to operationalize the 4 pillars. Step 1. The Audit, Pillar 1. Calculate your post-tax monthly income. Track every single expense for 1 month to find your true spending. Calculate your current gap. Income minus spending equals gap. Target immediately to increase this gap by a minimum of 10% of your income. Use budgeting tools, cancel unused subscriptions, renegotiate bills, and scrutinize recurring costs. Step 2. The Liquidity Moat, Pillar 3. Calculate 6 months of essential expenses: housing, food, utilities, insurance, and minimum debt payments. Open a separate FDIC/FSCAC insured high-yield savings account. This is your liquidity moat. Direct a portion of your monthly gap to fund this account until it reaches the 6-month target. This is your top financial priority after basic necessities. Step 3. The Asset Engine, Pillar 2. Open the appropriate tax-advantaged investment accounts. USA, maximize 401k employer match first, then fund a Roth IRA. UK, maximize your annual stocks and shares ISA allowance. Canada, maximize your TFSA, then RRSP. Australia, consider salary sacrifice into superannuation. Within these accounts, select 1 or 2 low-cost index funds. Examples: a total U.S. stock market fund, VTI, FSKAX, a total global ex-U.S. stock market fund, VXUS, FTIHX, a simple target date retirement fund based on your age. Do not try to pick sectors, time the market, or chase past performance. Complexity is the enemy of execution. Step 4. The Automation Loop. Work with your bank and brokerage to set up automatic transfers. Day 1, payday. Income hits checking account. Day 2, automatic transfer number 1, X% to liquidity moat until funded. Day 2, automatic transfer number 2, Y% to investment account. Day 3, investment account automatically purchases your chosen funds or funds. Schedule a yearly review, not a daily check-in. In the review, rebalance if allocations have drifted more than 5%. Assess your savings rate and adjust contributions as your income grows. Step 5. The Mindset for 2026 and beyond. When markets fall, remember that you are owners of businesses, not traders of tickers. A market decline is a sale on the productive assets you want to own for decades. Your automated system is buying more for less. Do nothing. When media screams crisis, recognize it as noise. The real crisis, the silent erosion of cash, is the one they rarely mention because it doesn't drive clicks. Return to this document. Reread the 4 pillars. When you were tempted by the next big thing, ask, is this a productive real asset or a speculative token? Does it fit my automated system or does it require me to break my rules? Speculation has created debt. Ownership of productive assets has created virtually all lasting wealth.
Conclusion: being the architect, not the tenant. The economic landscape of 2026 presents unique challenges: the tail end of an inflationary surge, the policy pivot to rate cuts, escalating currency wars, and geopolitical fragmentation. In this environment, the traditional set-and-forget savings mentality is a blueprint for financial obsolescence. The system outlined here requires no genius, no inside information, and no luck. It requires only understanding, discipline, and the courage to act on timeless principles rather than transient fears. It transforms you from a passive tenant in the financial system, subject to its storms, into the architect of your own durable fortune. You will not find headlines praising this approach. It is not sensational. It is not a secret. It is the profound power of simplicity, consistency, and logic applied to personal finance. It is how you ensure that when the storm of 2026 arrives, and history assures us a storm of some kind always does, you are not merely hoping to survive it. You are positioned to emerge from it stronger, with your purchasing power intact and your wealth compound engine humming quietly in the background, building the future you deserve. Start building your fortress today. The first brick is the decision to act. The next is the click to open that savings account. The journey of 1,000 miles and of a secure financial future begins with a single deliberate step. Take it now.